When you see a stock price flash across your screen, AAPL up, Goog down, what are you really looking at? It seems so simple, right? Just a number. But behind that number is a massive, highly engineered global architecture. A whole system of rules, contracts, and codes that dictates how trillions of dollars move around the planet every single day. So let's dive into this hidden world.
And the source material for this explainer frames it perfectly. For a real analyst, the market isn't just a casino for placing bets, it's a carefully organized system, a taxonomy really, of legal agreements. Every single thing you can trade, from a simple stock to a super complex product, is defined by a specific set of rights and obligations.
So, this brings us to the big questions we're going to tackle today. What exactly are these different financial contracts you can buy and sell? And maybe even more importantly, what is the secret language, the hidden plumbing, that allows the entire global financial system to identify and process every single one of them without, completely falling apart?
Okay, here's our game plan. First, we'll start with the absolute building blocks of the market, equity and debt. Then we'll get into exchange-traded products, or ETPs, where you'll see the structure is everything. And finally, we're going to do a comprehensive technical deep dive into the market's secret language, the global codes that make it all work.
All right, let's jump right into part one. Before we can even think about the complicated stuff, we have to master the fundamentals. These are the basic legal claims that pretty much all other financial instruments are built on top of.
So, first up, common stock. This is the bedrock of it all. The most important phrase here is residual claim. What does that mean? It means if the company goes bankrupt and everything is sold off, stockholders are the absolute last people in line to get paid. But the trade-off for taking on that massive risk is the potential for unlimited upside if the company really takes off.
Now, this is where things get interesting. Look at preferred stock. It's a true hybrid, kind of like a financial centaur. On the one hand, it acts like a bond. It pays a fixed dividend, and its price moves around with interest rates. But on the other hand, it trades on an exchange just like a stock and represents a piece of ownership, slotting in right between the company's debt and its common stock in the pecking order.
So, let's say you want to trade a Japanese company on a US exchange. How do you do it? The answer is a depositary receipt. Just think of it as a convenient wrapper. A big US bank will go buy a bunch of shares of that foreign company, bundle them up, and then list that package for sale right here at home. In America, we call them ADRs. In Europe, they're GDRs. They are absolutely essential for global investing.
Let's move on and see how this wrapper idea gets even more important. Exchange-traded products, ETPs for short, are incredibly popular. But that name is really just an umbrella term. The legal structure, the wrapper itself, is what truly defines the product, and more importantly, its risks.
Now, this slide highlights one of the most misunderstood concepts in all of finance. Pay attention to this. With an exchange-traded fund, an ETF, you own a small slice of the actual assets, the stocks, the bonds, whatever. But with an exchange-traded note, an ETN, you own nothing but a promise. It's a debt instrument, an IOU from the issuing bank, which adds a whole other, very serious layer of risk.
And this is why that distinction is so vital. This isn't just theory. When Lehman Brothers went bankrupt in 2008, it didn't matter what the index their ETNs were tracking was doing. The bank was gone, and so was its promise to pay. The notes became worthless. They went to zero. That is credit risk, and it's exactly why you have to know what kind of wrapper you're buying.
Okay, so we've got all these different securities with different wrappers. How does the global system possibly keep track of them all? Well, now we get into the real technical stuff, the plumbing, the secret language of identifiers that makes every single transaction possible.
We all recognize ticker symbols. They're catchy, they're easy to remember, they're made for us humans. But the machines that actually run the market, they don't use them. The real work is done by these complex, standardized codes designed to be unique, precise, and globally understood. That's how a trade in Tokyo can be settled correctly in New York without a hitch.
All right, so let's pull back the curtain. It's time to decode these identifiers. We're going to break down their structure, their logic, and see how they all fit together to form this global system of identification. We'll start in North America with the CUSIP. It's a 9-character code. The first 6 characters tell you who the issuer is. Think of it as the code for Apple Inc. The next 2 characters tell you what the issue is, like common stock. And that very last digit, that's a check digit, and it's a really clever little trick to make sure the code hasn't been typed in wrong.
So how does that check digit actually work? It's not random at all. It's calculated using a pretty simple algorithm called modulus 10. As you can see here, you just follow a few steps of converting and multiplying, and the check digit is simply whatever number you need to make the final sum divisible by 10. It's a surprisingly simple and really effective way to catch errors.
Okay, so that's North America. How do we take that system global? Well, that's what the ISIN is for. The International Securities Identification Number basically acts as a global wrapper. Just look at Apple's ISN. It starts with the two-letter country code, US. Then it literally just embeds the entire 9-digit QSIP right in the middle. Finally, it tacks on one more check digit at the end. It's a super simple, elegant way to standardize all the national codes.
Now there's another approach, and that's the FIGI, the Financial Instrument Global Identifier. A huge difference here is that it's an open standard, not owned by anyone. You can spot a FIGI right away by its BBG prefix. And here's a fun little quirk. The main part of the code uses only consonants. It's a clever design choice to prevent the random letters from accidentally spelling out awkward words.
But the real power of the FIGI, its killer feature, is its granularity. It works on multiple levels. So there's one FIGI for the idea of Apple common stock. Then there's another for Apple stock traded anywhere in the United States. And then there's an even more specific FIGI just for Apple stock traded on the NASDAQ exchange. That level of precision is just unmatched by the other systems.
So this table brings it all together really nicely. You've got the proprietary SUSIP for North America, you've got the ISIN standard that globalizes it, you have the open source and super granular FIGI, and then you have other important regional codes like the UK's SETL. Each one plays a really specific role in this complex web of identification.
So up until now, we've only been talking about identifying the instruments, the things being traded. But what about the companies and banks doing the trading? Well, that's the job of the Legal Entity Identifier, or LEI. It's a 20-character global code designed to answer two simple but critical questions. Who is who? And maybe even more importantly, who owns who?
And there's a really powerful reason the LEI exists. It was born from the ashes of the 2008 financial crisis. Back then, regulators realized they had no idea how all the major financial institutions were connected to each other. The LEI was created specifically to build that map, allowing them to track risk across the whole system by understanding all those parent and subsidiary relationships across the entire globe.
Which leaves us with one final, big, forward-looking question. This complex, honestly brilliant architecture of contracts and codes has kept markets stable for decades. But it was designed for a world of stocks and bonds. As we move into a new era of digital tokens, crypto, and decentralized finance, will this intricate, century-old plumbing be enough to support the markets of the future?